Everyone thinks silver moves on headlines. A few words from a bank strategist, a hot CPI print, a sudden spike in yields, and the metal reacts. That's the comfortable story because it makes the market feel readable. But the source material you gave me tells a different story. Silver is moving like a system under strain where public narratives and institutional behavior are no longer aligned, and where the most important signals aren't the ones delivered on television. They're the ones embedded in positioning, inventory behavior, and the hidden mathematics of paper claims versus physical metal. Right now, the source claims we're watching a familiar pattern return, not as folklore, but as architecture. It reaches back to a moment most investors only half remember. In 1997, with silver under $5 an ounce, Warren Buffett, through Berkshire Hathaway, allegedly went looking for something the market had mispriced. Not a trend, not a story, an imbalance. The source says he quietly accumulated 129.7 million ounces of physical silver, almost 4,000 tons, a position so large it represented roughly a fifth of above-ground supply at the time. The world laughed because the world usually laughs at value when value doesn't come with glamour. Then the price climbed, the position unwound over years, and the profit, by the source's telling, ran into the hundreds of millions. That would be a compelling historical anecdote on its own. But the reason it matters now is that the source insists the same ingredients are back on the table, only larger, tighter, and more politicized. The claims stack up like pressure plates. Silver, it says, has been in a structural supply deficit for 5 consecutive years. Mine production peaked in 2016 and has fallen by 2025. Demand isn't just investors chasing shine. It's solar panels, electric vehicles, 5G infrastructure, and the physical wiring of the AI era. And while this is happening, the source draws your attention to a single institution with a complicated history. JPMorgan, the same bank that paid a record penalty for silver market manipulation, publicly warning of lower prices while, according to the source, quietly accumulating vast physical supply. The tension isn't just bullish versus bearish. The tension is moral and mechanical. Because if the public is being guided one way while balance sheets move the other, the market stops being a price discovery mechanism and starts becoming a transfer mechanism. To understand how that could be true, we have to go back to the blueprint, the way silver is supplied, the way it's demanded, and the way paper markets can overpower physical reality until they can't. Start with the simplest version of the system because silver is not one market. It's 2 markets stitched together. There's the physical world, metal, mined, refined, shipped, fabricated, stored, and delivered. And there's the paper world. Contracts, forwards, futures, and promises that behave like silver, trade like silver, and influence the price of silver without always requiring silver to change hands. The source material builds its foundation on a single idea. Scarcity is no longer theoretical. It claims the market has been running a structural deficit for 5 years straight, meaning consumption exceeds production, not as a one-off shock, but as a persistent gap. In 2025 alone, it estimates a shortfall around 230 million ounces. At the same time, it says mine supply is drifting downward from a peak near 900 million ounces in 2016 to roughly 835 million ounces by 2025. That is not just a line on a chart, it's the definition of inelasticity. The source emphasizes that most silver isn't a T-mine because people want silver, it ain't mined because people want copper, zinc, or gold, and silver rides out as a byproduct. You don't simply turn on silver production the way you might ramp a pure play commodity. Then comes demand, and here the source stops talking like a coin dealer and starts talking like an engineer. Silver is described as a strategic industrial input, with solar photovoltaics alone consuming around 15% of global silver use, because silver paste has conductivity properties that still lack a cost-effective substitute at scale. It stacks additional demand drivers, electric vehicles, 5G infrastructure, and the physical guts of AI data centers, charging systems, circuit boards, server components. This isn't a passing fashion, the source argues. It's the material substrate of a new economy. If this pattern is starting to click, if you can feel how supply rigidity and industrial necessity create a different kind of pressure, hit like and subscribe. It genuinely helps this reach more people who want analysis that treats markets like systems, not entertainment. Now keep going, because the next layer is where this stops being a simple bull case and becomes an institutional story. The source also introduces valuation through the gold to silver ratio, pointing out that historically the ratio averaged around 15-1, and that even after silver's surge, the ratio remains out of whack, implying room for mean reversion. But the most important foundation brick is not the ratio. It's the behavior of large actors when volatility hits. The source describes silver's explosive rally, 2025, moving from roughly $29 to above $72, with intraday spikes near $100 in early 2026, followed by violent sell-offs and sudden crashes. The key claim is that volatility does not break the thesis. It tests who owns the metal and who only owns the idea of it. Everything so far sounds like a powerful macro setup. But here is what the source suggests most people miss. When a market has both structural deficits and huge paper leverage, the real risk isn't just price swings. The real risk is a credibility event, when too many people want the same physical thing at the same time. This is where the public story and the private incentives diverge. The source puts JPMorgan at the center of that divergence, not as a random villain, but as an institution with history. It reminds the viewer that the bank was penalized in 2020 by U.S. authorities for spoofing in precious metals markets, with a headline number of $920 million described as a record penalty, involving the Department of Justice, the CFTC, and the SEC. That detail matters, because it changes how you interpret present-day messaging. When an institution has been punished for manipulating a market, every future forecast it publishes becomes more than analysis. It becomes a signal with a past. Now layer in the claim the source wants you to sit with. JPMorgan analysts warning publicly that silver could crash back to $50 in 2026, while according to the source, the bank itself has been accumulating massive quantities of physical silver. An estimate as high as 750 million ounces is stated, though the source does not provide the underlying inventory document. It frames this as a classic institutional pattern. Talk down the price, buy the thing. Create fear, harvest supply. If you're a retail buyer reading those reports, you experience them as guidance. If you're a balance sheet with deep pockets, you experience them as leverage. The escalation accelerates when the source shifts from psychology to plumbing. It claims the futures market can create distortions so large they start to define reality. It points to a March 2026 silver futures contract representing 528 million ounces of paper exposure, contrasted with about 113 million ounces of physical silver available for delivery in exchange warehouses. The numbers themselves are less important than what they imply. Multiple claims layered on top of a much smaller pool of deliverable metal. A system like that functions as long as most participants treat contracts as cash-settled instruments and never ask for the underlying commodity. The moment too many ask, the system is forced to reveal what it is, a market built on confidence. And that's the inflection point the source is driving toward. Because once you accept the possibility that paper silver can outsize physical silver by multiples, price becomes a governance tool. If you can push price down during thin liquidity, if you can trigger margin calls, if you can cascade stop losses, you can force liquidation by participants who never wanted to sell. The source even gestures at the late January 2026 crash from near $100 to the low 60s, attributing it to margin requirement changes, profit-taking, and a narrative environment shaped by bearish institutional commentary. No single piece proves a conspiracy on its own, but the source isn't asking you to believe in a shadowy room. It's asking you to see the incentive structure. If physical silver is tight and getting tighter, if industrial demand is structurally rising, then the greatest advantage isn't predicting the next candle. The advantage is owning the metal while convincing others not to. And if you think that's the full picture, we're not even at the most unstable part yet, because the most unstable part is not price. It's delivery. Here's what all of this adds up to, according to the source. Silver is not merely undervalued. It's structurally stressed, and the stress is concentrated at a single seam, the seam between paper obligations and physical availability. The revelation isn't that shortages exist somewhere. Shortages exist in lots of commodities at different times. The revelation is that a market can appear liquid and abundant on screens while becoming illiquid and scarce in warehouses. The source points to signs of stress in London, mentions delivery delays, and describes tightness in Chinese markets as well. Those references are not expanded with documents inside the source, but they serve a narrative purpose. The shortage is not local, it's systemic. Then the source brings the story back to Buffett. Not as a literal claim that Buffett has already made a new 2026 purchase, because it concedes Berkshire filings do not show a massive silver position right now, but as a value investing lens. Buffett's historical approach, as the source frames it, is not chasing hype. It's buying asymmetric setups where fundamentals are real, supply is constrained, demand is rising, and the market is asleep. In 1997, the source says, Buffett saw that imbalance before the crowd. Today, it argues, the imbalance is larger, a multi-year deficit, declining production, and a demand stack tied to solar capacity projections reaching 2,500 gigawatts by 2030, with solar alone potentially consuming over 200 million ounces annually. Whether or not that projection becomes precise reality, the direction is the point. Silver demand is being pulled by policy, technology, and electrification, not just investor sentiment. So the question becomes sharper. If a market is running deficits, and the paper layer is multiple times the deliverable layer, what happens when investors stop treating silver as a trading token and start treating it as a strategic asset? The source suggests that sovereign buying, particularly from China, is rising. with the implication that silver is being viewed not only as an industrial input, but as a resource with strategic leverage. Again, the source provides no official confirmation inside itself, so the responsible framing is pattern-based. The evidence points to growing strategic interest. Here's the question embedded in everything the source is showing, and it asks the one mainstream coverage rarely asks. If institutions can shape the price through paper mechanics while quietly acquiring the physical, is the price still a signal of value, or is it a tool of extraction? Drop your analysis in the comments. Not a slogan, not a prediction, your reasoning, because the only way to break a narrative monopoly is to replace it with disciplined thinking in public. And this is where it stops being about institutions and spreadsheets, because if the seam between paper and physical breaks, it doesn't just change a chart. It changes what your savings can buy, how fast purchasing power erodes in an electrifying economy, and who gets priority access to the materials that future infrastructure requires. Go back to the opening, to that comfortable belief that silver is a headline market. The source material challenges that belief with a harsher lens. Silver is behaving like a rationed resource hiding inside a financialized wrapper. And financialized wrappers work beautifully, right up until the moment they don't. The resolution here isn't a promise that silver will only go up or that a specific target is inevitable. In fact, the source itself acknowledges violent volatility, sudden spikes, sharp corrections, margin shifts, and sell-offs that can erase weeks of gains in days. The honest takeaway is not certainty. The honest takeaway is structure. Volatility in the source's framing is not evidence against the thesis. It is the mechanism by which the system transfers exposure from weak hands to strong balance sheets. So here we are at a crossroads that looks like investing but behaves like strategy. Path A is the status quo. Most participants continue to treat paper silver as sufficient, the deliverable layer remains small, and price is heavily influenced by leveraged positioning. In that world, institutions with deep pockets can use fear, liquidity timing, and market structure to accumulate while others hesitate. Path B is a slow shift in awareness. More participants begin to care about the difference between an asset and a claim, between a contract and a bar, between exposure and ownership. The shift doesn't need to be universal. It only needs to be large enough to stress a system built on the assumption that most people don't ask for the underlying commodity. The source ends with a form of agency that isn't naive. It doesn't say you can defeat the system by sheer will. It says you can stop being manipulated by misunderstanding it. If you choose exposure, understand the counterparty and the mechanics. If you choose physical, understand storage, premiums, and liquidity. If you choose mining equities, understand leverage cuts both ways. The point isn't a one-size prescription. The point is literacy, because literacy changes the math, and when enough people change the math, the system has to adapt. There's also uncertainty the source implicitly leaves on the table. We don't have the internal documents it references. We don't have an official, sourced inventory statement for the most dramatic accumulation claims. We don't have a guaranteed roadmap from deficits to a delivery event, but we do have a coherent structural argument inside the source. Deficits persist, industrial demand expands, production is constrained, and paper claims can outnumber deliverable supply by multiples. That combination makes silver less like a simple trade and more like a stress test of financial credibility. The final lens shift is this. Silver was never just about a shiny metal or a speculative spike. In the story your source is telling, silver is about who controls the difference between reality and representation, between what exists and what can be promised. They designed this market to feel liquid on screens. Now you know where the seams are. And what you do with that knowledge is the only variable the system can fully price in.